Today I want to talk about Chipotle and thinking longer term when you're investing. So a lot of investors won't invest in companies because they seem too expensive. They won't do any research because of that on the company. But I think a lot of times they're missing the point. You know, I believe that yes, valuation is important, but you got to think longer term first. So if the fundamentals are great on a company and the valuation seems expensive this year, then I want you to think out longer term. And I'll give you an example. So Chipotle is a company I invested in years ago. The ticker was CMG. And the reason I invested was because I did a lot of research on the company and it was trading at only 5 times my earnings estimates in 5 years. And I'll explain what that means. So a lot of people did not invest in Chipotle, and I made mistakes too, but this one worked out for me. A lot of people didn't invest in Chipotle because it seemed really expensive on this year's and next year's earnings at over 100 times. But what I did was this. So Chipotle, for those of you who don't know, is a great Mexican restaurant here in the States. And it was actually initially owned by McDonald's. And McDonald's actually spun it off into a separate company in order to enhance McDonald's shareholder values, okay? So what I did was this. When I was doing research on the company, I called McDonald's. And this was, I think, 8 years ago, 9 years ago maybe. I called McDonald's in Chicago. And I called investor relations, and anybody can call investor relations. All you have to do is ask. And I asked them to send me all of their annual reports from the beginning of their existence. And so they sent me a bunch from the 1960s, and then the 70s, and then 1980 or so. And what I did was I looked at the number of stores McDonald's had to open at the time in the 60s, 70s, and 80s. And I realized, based on my research, that Chipotle was basically, when I invested, where McDonald's was store-wise in the 1960s. And there's a lot of great growth opportunities, right? A lot of great growth opportunities. And that helped me to think longer term, which is really important when you're investing in any company, especially tech companies, but I want to talk about Chipotle and retail today. So the growth was torrid, and Chipotle at that time was trading at single-digit earnings estimate based on my 5 and 10-year outlook on the company, okay? And if you think longer term and you pick 5 to 10-year target prices when you invest, then you won't be scared to sell or be a tourist or just rent stocks. You'll be long-term owners. And so the best way to think about it is this great analyst that worked for me years ago coined this phrase. He said, Chris, I don't know the path, but I know the destination, and it's much, much higher, right? And so it allowed me to stomach the volatility in the stock when I first started buying it and investing in it, because remember, Warren Buffett always says that the New York Stock Exchange is the only store in the world where consumers sell stuff when it goes on sale. So you got to think longer term. So let's talk about retail stocks today. So when you invest in retail companies, the most important thing you can look at is something called SSS, which means same store sales, okay? Every sector has a driver that you got to look at. For retail, it's same store sales. And the reason I say that is, yes, you can have great revenue growth year over year for a retail company, but if they open 1 million different stores, I don't want to give them credit. I want to look at same store sales difference year over year, the growth, right? And the same thing for the hotel industry. You look at what's called RevPAR, or revenue per available room. And so let's talk about McDonald's, because we covered Chipotle already. And Chipotle, by the way, I love that company longer term because there's no real incredible, decent Mexican restaurant, fast chain globally that's kicked ass, right? I mean, there's Taco Hell. I'm not going to go there though. Taco Bell. All right. So when we look at same store sales, so you look at McDonald's, and McDonald's had torrid growth for years, right? The same store sales was growing a lot as it became more and more popular. And then what happened was there was a gazillion different hamburger restaurants, and growth slowed a lot for McDonald's. With Chipotle, there's not a gazillion different Mexican restaurants. There's only Chipotle, in my humble opinion. That's why I loved it. And so McDonald's growth was slowing. So what McDonald's did was pretty smart. To get shareholders happy again, what they did is they started selling coffee. And so same store sales grew a lot, and it was a higher margin product, right? Because it's just a beverage, it's liquid. Actually, McDonald's doesn't make money on hamburgers. They make a lot of money on drinks and a little bit of money on French fries. That's why they always say, would you like a Coke with that? Would you like fries with that? And smiles are free. Okay, sorry, dad humor. And then what happened was, after they had coffee in their stores, it was great. But at a certain point, the year-over-year growth slowed again. And so what McDonald's did was they said, okay, what can we, oh, let's open 24 hours a day. And that's what they did. And so growth was amazing. And then the year-over-year growth comparisons got tough, and there was less growth per store, same store sales year-over-year. And so they did something else. They had breakfast all day, which is great because I remember going at 11 o'clock, you know, with my kids. We wanted breakfast, and breakfast was over, and it was a disaster. But they did have Happy Meals, which helped. So when you look at retail companies, you got to think of SSS, same store sales growth year over year, and that's called organic growth. Okay, and that's the next topic I want to talk about now, which is buy versus build. I'll explain what that means. So for a lot of companies, they get so big and so bureaucratic, especially when the founder leaves or is not engaged. And what happens is, oh my God, I smell marijuana. It's legal now, I guess. All right, here we go. I might be a little bit high when I talk about this now. Hope that's okay with you. Thank God McDonald's is open 24 hours. All right, so, oh, check this perspective out. I love this. How cool is that? Is that dope or what? I'm gonna stand here for a second and vlog. All right, so you gotta look at organic growth. So companies get really big and they can't grow anymore. And so what they do is they start buying companies. And don't give them credit for that though, okay? Generally speaking, if you see revenue grow a lot year over year, I want you to do more research. Look into the annual report and say, gosh, did they buy somebody or not? Right, and LinkedIn was one of my favorite companies to invest in for years. And they bought a great company called Lynda. And so revenue growth was amazing year over year. And then revenue growth slowed. They hit a speed bump. And all right, this is my personal opinion. They had to sell themselves to Microsoft. And when you look at a company like Microsoft or Oracle, two great big software companies, whenever they do big acquisitions, it's a double-edged sword, man, because that means they got to buy a big company every year. Otherwise, growth goes negative. And that's what you saw with Oracle. So Oracle has to buy a massive software company every single year. And there's a brilliant woman named Safra Catz, who used to be the CFO. And so she kind of pioneered this whole process at Oracle. Every year, they have to buy a massive company, otherwise growth slows, right? And so I talked about NetSuite in this vlog here, where I talked about the four most dangerous words in investing, which is this time it's different. And Oracle bought NetSuite. Oracle bought PeopleSoft, which is HR software. They bought Siebel. They'll continue to buy other companies longer term, right? Because if they don't, then it'll look like growth is actually negative. Isn't that beautiful? Look at that perspective behind us there. Stunning. Okay, it's stunning. So companies have to keep growing or Wall Street gets mad. I prefer it when they actually build products themselves rather than buy them. Because if you buy growth, you should not get credit for that. And when it comes to retail restaurants, remember to look at same store sales. And with hotels, RevPAR, revenue per available room. So we talked about the retail sector in a lot of detail today, and every sector has a driver, okay? And in upcoming vlogs, what I'll do is I'll talk about different sectors and what the drivers are. But the bottom line is that for retail companies, it's same store sales. And I also want you to think longer term. And if you build a financial model, I want you to pick a target price 5 or 10 years out, and don't just rent stocks. Don't be a tourist. Be a long-term owner and just kind of see the forest. See if I can do this perspective. Try to see the forest from the trees when you invest, and just think longer term. All right. So if this was helpful, and only if this was helpful, please click like and subscribe, and I will see you mañana. Thank you.